Thanks for clicking. The mortgage delinquency rate in Ontario and BC is surging, though down Canada-wide. All the while, Canadians are continuing to pile into more debt amid the mortgage renewal wave. This according to recent reports coming from the CMHC. And yeah, while surging delinquencies in Ontario and BC isn't great, a closer look at the data, including who is doing the loan increases and more importantly why they're doing it, shows that more stress could be coming to Canada's real estate market. Or, as the media put it,
"You didn't see nothing. Now beat it."
Yeah, but as we'll also see today, the media choosing not to cover something is actually a fairly big improvement from their usual antics. So what I want to do today is go over the residential industry mortgage report, putting everything into context while looking at what this data can tell us about the current state of the real estate market, and then go over why, despite what the media tells us, all of this stuff was predictable if you looked.
You just use your brain once in a while. You might like it.
The first of the month is fast approaching, and with that we are eagerly awaiting the release of November's real estate data coming out from the local boards, and we'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into these reports. Onto these reports. As mentioned, mortgage delinquencies are surging in Ontario and BC, with Ontario being above the national average for the first time since 2012. Delinquencies in Toronto alone are up 60% since this point in time last year. And yeah, if we pull some additional data from CMHC's website, we can see that not only are mortgage delinquencies in Ontario and Toronto up higher than they've been for the past 10 years, they're also moving up extremely fast. And even more importantly is the context. All of these delinquencies are occurring at a time when the unemployment rate is significantly lower than they were the last time delinquencies were this high. Which tells me, combined with the refinance data that we're about to go over, that these delinquencies aren't Trump's fault as of yet. Rather, they're due to the cost of living and the renewal wave coming to fruition. And while that's definitely not great, if we delve into the data, we can see there's a lot more interesting stuff than that which is making the relatively minimal headlines. You guys didn't even write your own pieces. You just took it from the Canadian press, copy-pasted, and went on with your day.
It's not important.
Yeah, as a side note, this was the media attention devoted to the CMHC story over the past week, and this was the media attention devoted to Phil Soper, CEO of Royal LePage, author, as we've discussed before, of The Renewal Wave Was Almost Over in 2024.
We're over halfway.
Regardless, here's the big piece of data that I think is the most telling. Those without a mortgage are now starting to fare better than those with a mortgage, with those with a mortgage now seeing their non-mortgage delinquencies starting to increase at a faster pace than those without a mortgage. And that's a big shift. It was only about a year and a half ago that the Bank of Canada was stressing it was not cutting interest rates as fast as many had hoped, as renters were feeling the squeeze of inflation far more than mortgage holders. The point was so much the focus that the Deputy Governor actually pivoted to renters when she was asked why the bank wasn't cutting rates fast enough to save the renewal wave.
But the effect of the credit stress we see is also showing up in renters too, and that's really inflation.
But this relative strain on purely renters isn't so much the case anymore. With auto delinquencies slowing, the rate of growth for delinquency on lines of credit and credit cards slowing for non-mortgage holders, whereas credit stress is growing across all mortgage holders. And a bit more digging helps to further reiterate the problems facing mortgage holders, as mortgage debts are continuing to increase despite a dormant housing sector. As we can see here, total mortgage debt being taken out by Canadians has continued to increase throughout the year, especially those uninsured mortgages, those refinances, which enable borrowers to take money out of their home. Yet, as we can also see, the number of outstanding loans isn't increasing all that much, meaning this increase in debt is stemming from homeowners taking money out of their homes. A point, again, reiterated by the Residential Mortgage Industry Fall Report, showing a big increase in refinances since 2024. According to that report, 22% of those refinances are going to pay off debt, while another 14% were to extend amortizations. So putting this all together, mortgage holders are seeing a big increase in delinquencies of their non-mortgage debt at a time when they're undertaking refinances, taking money out of their home, all for debt management purposes. Homeowners are increasingly accessing what's left of their home equity for debt management purposes.
Well, that sounds good for both of us.
And the reason why this is concerning for the future of the real estate market is that, as we went over in great detail in August, this option may not be on the table for much longer. The amount of equity available for them to pull out of their home to put towards those credit cards, it's dropping quickly. Anybody that bought after February of 2021 is no longer able to refinance. And those March of 2021 renewals are coming up very, very quickly, meaning those who took out a mortgage after March of 2021, those with minimum down payments, won't be able to pay off their debts vis-a-vis a refinancing, which is starting to very much show up in the data. But this really shouldn't be coming as a surprise to anyone that so many mortgage renewals are coming up and that people are going to have a hard time making their payments. Here is June of 2024 on this channel. You can see here right in the data that the major payment increases don't really start at the beginning of 2025. They don't really start until about midway through 2025 and then peak in 2026. And to come up with that assertion, all we did was pull the purchase prices between 2020 and 2022, looked at the average interest rate for all of those purchase prices, calculated minimum down payment requirements, and the estimated remaining balance at the end of the term, used a 4% renewal interest rate, and showed when the majority of the payment increases were expected to start. Starting in May of 2025, which is exactly what we're seeing at least in Ontario and B.C. Those places where the pandemic housing price boom were the highest. But as much as this delinquency data coming from CMHC helps to validate that study that we did in June of 2024 on this channel, it also helps to negate the views being put forward by some of our most popular media outlets. Those outlets that rely on experts, sans data. CBC published a video in August of this year telling us that it could be now or never for first-time home buyers.
Interest rates have finally started to come down, and so there's kind of a reemergence of first-time buyers.
I made the point at the time that these experts couldn't have known if these rate drops were pushing first-time home buyers into the market, as A, fixed rates weren't down, and B, into June, we've seen a decrease in variable rate usage relative to that of fixed for insured mortgages. And now, fast forward to the release of this data from CMHC, and yeah, variable rate usage continued to fall. So how exactly were these non-existent lower fixed rates and non-used lower variable rates pulling homebuyers back into the market?
I don't know.
And since the underlying basis upon which this now or never argument was built did not exist, buyers did not flood back into the market. Here's Toronto's October sales relative to the previous 11 Octobers. Or recall, as we often do, so long as he continues to get put on the air, Phil Soper telling Bloomberg just a year ago that the mortgage renewal wave was 3/4 of the way over.
3/4 of mortgages written during those pandemic lows will have rolled into post-pandemic rates by the end of 24.
And again, no data, no sources, and as CMHC's report is showing us, that did not pan out. So yeah, if you don't look at the data, if you don't use data when you espouse these assertions, you're not going to get the future right. Or conversely, if you do look at the data and spout a self-serving view anyway.
That's what we're looking for.
In summary, stresses are continuing to merge for Ontario mortgage holders, with delinquencies in Ontario moving close to 2012 levels and rising, with non-mortgage delinquencies surging as well. And all of this was entirely predictable almost to the month if you looked at the data, which the media and the industry doesn't often bother to do so. And just remember that as December unfolds, as January, as February continue to unfold, and these experts, both from the media and the industry, tell you that the housing market is about to take off. Are they using data? Are they showing you their methodology? Or, as per usual, are they getting their market learning on the street? What they're hearing on the street, what they're hearing from their friends, which, as of at least the past 3 years, never seems to pan out. And conveniently, that's the kind of data, the personal data, the data you get from the 3 or 4 people that surround you, that's the data you never have to prove actually existed.
A lot of people have asked us.
With that said, we will continue to provide the data and show our methodologies on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.